Welcome to the condensed version of the daily video update, where I'll go over the action in the market for Thursday, July 20th, and then we'll see how things look for Friday, July 21st. I'm a little bit late doing the recording for this today. I had to deal with a chainsaw concerto, which was preventing me from doing any recording. We had a down day. As of right now, it looks like we're just experiencing a short-term pullback. So let's go back and talk about what happened. The convergence between the negative signals, it looks like those were all coming together, and right now it does look like it's a short-term pullback. If we see more weakness, we'll fall back and regroup and then decide, okay, where do we go from here? We can only take this one day at a time. The broad market held up better on Thursday than the mega cap stocks. The mega caps had been really strong lately, so a lot of people were trying to lock in those profits by selling. The Dow was up on strong earnings news, so that was another positive thing that happened. The positive scenario that the market's been dealing with, that still continues. The idea that we're going to have a soft landing. Even though we're seeing economic weakness, we won't necessarily go into a recession. They're also under the belief that the Fed is almost done raising interest rates, and then when looking out into the future, earnings are still looking healthy. Now, this can change at any time, but this is what the market is latching on to right now. On a short-term basis, our list is getting a little bit shorter, but we're still overbought. We have the moving average study, the CMB composite, the CCI based on 20 periods, the standard deviation chart, and the stochastics. Also in the intermediate term, we still have some extreme readings with the PMO studies. Our oscillators, they're looking better overall. The ones that we follow typically, it's the NASDAQ 100 that we're really focusing on right now. The Sean Trend Meter and the BPI for both the S&P 500 and the NASDAQ 100. On a long-term basis, we still have some of our longer-term moving averages that are looking pretty extreme. The dollar advanced and interest rates were also up. All the yield curves that we follow are still inverted. We're waiting to see if they shift back to being more normal. They haven't done that yet. Sentiment is still extreme positive at 80. There's a lot of exuberance in the market still. Our trend is positive, but with the down day, the green line is starting to come down, but the ADX is still above its moving average, and both of them are above 20, suggesting that we are in a trending environment, and for right now, we still default to the positive. I'm keeping our bias at positive, even though we had the down day. We're still looking more positive in the background, and our momentum continues to be positive. The economic reports that came out, we had the Philadelphia Fed Index. It came in at minus 13.5, more than the minus 0.9 they had expected. Last time we had the report, it came in at minus 13.7. Weekly jobless claims fell, which is also indicating that the employment situation is remaining strong. They expected 240,000 new applicants, but they got 228,000. Continuing claims are going up a little bit to 1.754 million. Existing home sales were down 3.3% month over month. When you look at that on an annual basis, it's 4.16 million. They expected 4.25 million. Last time we had this report, it was at 4.30 million. Sales were down 18.9% if you go back and look at a year ago, and the leading indicators were down 0.7%, a little bit more than the 0.6% they had expected it to be down, and last time it was down 0.6%. Here's our intraday chart showing that we did have a lower open. We went down to S1 immediately, tried to bounce back up a little bit, then came down all the way below S2, bounced up off of that, got back above S1 just a little bit. Then we came back down to S2, camped along there for quite a while. Then we broke lower. We didn't get all the way down to S3 and then saw a little bit of buying going into the close. Here's the growth versus value chart for the S&P, where it was negative overall. So that's turning a little bit more negative now. We're also keeping an eye on the VIX to S&P 500 correlation. We spiked up and now we're starting to come back down. A lot of times in this context probably means that's more negative for the market. Also, this is a newer chart that I've expanded a little bit. This is that same chart, but on a shorter time frame. This is the 5-period simple moving average of the equity put-call ratio. See the red line down here? That's 0.55. Other times when we drop below this level, and if you look at what happened with the S&P after that, it usually signaled some kind of a decline. In fact, back in August of 2022, it hit the exact top. We're trying to figure out over here on the right, have we bottomed and are we going to start to go back up now? Or is this going to turn and actually come back down? Here's the daily chart showing how we came up to the underside of this trend line. We hit that and now we've been bouncing back down. On the bottom, you can see where we've had 3 days now of above average volume. The NASDAQ, we're following this 61.8% retracement level. We're coming back down. If we continue to fall, we'll be watching the 13,874 level. Then for the NASDAQ 100, we came up to this R2 level and now have been coming back down. We even closed below R1. We're still above this previous high. If we continue to fall, will this act as support? If we end up falling through it, that could turn things more negative. Then here's the NASDAQ 100 with the negative divergence, where the NASDAQ 100 was making higher highs, but the PPO, which is a momentum oscillator, it was making a lower high here, and that was another signal we were watching. Then on a weekly chart of the S&P 500, we're still above this resistance level. Now, each one of these bars is a week, so we won't really know how this finishes until after Friday's session. But for right now, this level is holding. Then when we look at the NASDAQ 100 weekly chart, we're also above this resistance line right here. Will we fall back down, or can we stay above this level and possibly go higher? Looking at the NASDAQ 100 to Dow ratio, we're still at a very high level, even though it ticked down slightly. There's nothing to say that we can't go higher than this, but when we reached this level before, that projected bad things for the market going forward. We had the top in 2000 and then a lot of damage after that. This was the top in late 2021, which led to a lot of the declines we saw in 2022. So what's our outlook for Friday? It will be options expiration on Friday. They actually expire on Saturday, but the last day you can trade them is on Friday. But that's kind of its own little day, and we might see a real pickup in volume. The rebalanced NASDAQ 100, that was based on a week ago. Well, they'll actually unveil it on Monday. That can have an effect on how things behave. The technicals are still positive for right now, and right at this moment, it looks like we're just working off being overbought. We won't get any economic reports on Friday. We're keeping an eye on all of the geopolitical events, but the market continues to be fixated on inflation and interest rates. Here's the updated economic calendar for the week. Also for the Stock Traders Almanac statistics, we are in options expiration week where we're up 57.1% of the time. We've been down 42.9% of the time, going back to 1980. Looking at July 21st, we're negative across the board with the Dow, S&P, and NASDAQ. So historically, this has not been a positive day. We will be on the 14th trading day of the month, which is also options expiration, where we're kind of in the middle part right now where we see some monthly seasonal weakness. We're also keeping an eye on this chart for the NASDAQ, where we've hit the middle part of July, where typically we will see some weakness after this. That just means historically. Doesn't mean it's always going to play out that way. So our scenarios, we're not going with the down one yet because it just looks like we're working off being overbought at this point. If we have more downside, that could change things, but we can only go with what we see right now. We're still defaulting to the up scenario, but we are working off being overbought. So be careful with that if you decide to go long. We're not going with the sideways trend right now because our ADX and its moving average are above 20, suggesting that we're in a strong trending environment. The warning signs, the convergence signals that I talked about yesterday, we're still keeping an eye on those. The S&P to VIX ratio, the 5-period simple moving average of the equity put call ratio, the negative divergences specifically for the NASDAQ 100, and that we're seasonally in a weak time of the month. The longer-term trend signals may be signaling a top. They're not necessarily doing that yet, but if we have a down day on Friday, that might change the situation. Seasonally and historically, this is a weak time of the month. Our oscillators are still negatively diverging, especially the NASDAQ 100, but our other oscillators are showing some improvement. The VIX is still showing complacency. That's why we're watching the S&P to VIX ratio. The cumulative new highs, new lows. They ticked up the last couple of days on the NASDAQ, but they're still showing overall weakness. The 3-month yield is above where it was at back in 2007 before the great financial crisis. The S&P has growth that is weakening even though it's still in an overall uptrend. And then we're in the middle of earnings season now, which can be positive or negative. Our positive signs. We still have these things that I go over in the weekly video that talk about seasonality and setups that are still in the background. The long-term daily special K chart is positive, but please be aware that the weekly chart continues to be negative. The long-term equity put-call ratio continues to be positive for the market. The S&P is still above a downtrend channel upper line that I haven't shown in a while because we're still far away from that upper line. We're still in a risk-on posture, meaning folks are favoring stocks over bonds. Lower price levels so far have been holding up for support. We'll have to see if that can continue. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're still above that breakout level, but they came down from those pivot levels. That's a bit of a concern. The Staples to S&P 500 ratio is still declining, and the small cap index that we look at based on the Russell 2000 as well as the mid caps generated recent golden crosses. We're not quite there yet with the S&P small cap index, but we're getting closer. Small and mid cap growth continues to be positive, and the Copic curve generated a recent buy signal. So our conclusion, the S&P is still positive for right now, and it's just working off being overbought. We're falling back to see if it's going to turn into more weakness. We can say that for the short term as well as the intermediate term. We're still positive in the long term. Thank you. I hope you have a really good day. Please feel free to check out the full-length video, and I will talk to you in the next video.